Good morning, everybody. Welcome to the Flow Show. It's Thursday. I think it's Thursday anyway. Morning, Stel. How you doing, mate?
Good morning. Everything good? Sorry I couldn't make it yesterday, but I'm here today. Better late than never.
No worries. Pleasure to have you here now. So that's all good.
Good stuff.
All
How are you,
fine and
mate? You
dandy.
good?
Yeah, all good, mate. All good. Busy morning. Lots going on.
Yes.
And I actually find myself with a flat book at the moment. Which is
A flat book.
surprising.
Wow.
Yeah. Completely out of everything for the moment, which
Good.
is a weird feeling. I always like to have a finger in a pie somewhere, but not this morning. But we shall get into that in a moment. So let's kick right off. It's PMI day across the globe. Manufacturing, the first time first and foremost. Looking, we'll go back to yesterday's data first, just to cover some of that as well. German CPI data, unsurprisingly, coming in much softer than expected. As we mentioned, these expectations were wrong on this calendar. I mentioned that in our chat room just before the data. They obviously got revised down after all those lower regional CPI numbers out of Germany, but even so, they came in softer than even the revised expectations. And that's followed suit this morning, which we'll talk about in a moment. Canadian GDP came in a bit of a surprise, strong growth. The annualized quarter-on-quarter number 3.1% versus 1.5% expected. Even the normal quarter-on-quarter number at 0.8% beating expectations. The year-on-year number not quite as high as expected, but still up on last month. So good numbers there from Canada. Over in the US, the JOLTS data did a complete flip. Bucked a trend lower that it'd been running for quite some months, coming in at a whopping 10.103 million. So a big reversal there from the JOLTS. Chicago PMI looking a bit sucky there at 40.4 for that one. Now coming across to, as we say, to the PMIs coming out today, manufacturing. Australia, a little bit of an improvement, but nothing to write home about on that front. Japan, little tiny bit softer, still in expansion there. Coming through, got some Aussie retail sales as well, which was flat. Par for the course, really, what we're seeing in a lot of the data. China, manufacturing, one of the other. This is the bank. Let's call it sponsored manufacturing PMI. So it's like the S&P Global or the market manufacturing number. A little bit of an improvement there to 50.9 versus 50.3 expected and moving into expansion. So bucking the trend a bit from what we saw from the other China PMI that was out a couple of days ago, which went further into contraction. So a mixed picture there, but it hasn't really changed much as far as China's concerned. Coming over to the Eurozone, and German retail sales positive, but not as much as expected. Onto the PMIs, and we can see there Spain a little bit healthier, still in contraction, 48.4, beating the expectations, but not quite matching last month. Switzerland as well, getting worse. Italy, getting worse, 45.9 versus 46.8 prior. France, even worse. Germany, a little bit better than the flash number, but still a fall on last month. And there is Greece, a little bit of a pullback in Greece, but still looking healthy. You must be one of the only ones, mate, in expansion at the moment.
Mate, I'm trying to support the economy, but there's only so much I can do.
What are you making over there?
You know what, though? We've been through some really painful years, and it makes sense to have expansion after that. I mean, people talking about how the Greek stock index, the Athens stock index, is the best performing out of all the European indices year to date. Well, if you look at how much it's dropped over the past 10 years, it's ridiculous. So, it's up 30% this year, but it was down, 70% from the high. So there's always a reaction, a positive reaction after a big downtrend. But, it's always nice to see the economy doing well, no matter what's happened before.
Yeah, and long may it last, mate. Long may it last.
I am my own central bank. Yeah, Bran, exactly.
Everyone is their own central bank out in Greece, given the money they got over the last few years from from the rest of Europe. So not surprising there. Yes, the Banker Stelios. I'm sure he'll do you a good rate of exchange if you ever go over there. So as we can see, just continuing on the theme, manufacturing PMI is continuing negative. The Eurozone measure, Norway coming over to the UK, another contractionary number. Not as much, not falling as much as was expected, but still all negative. So you get the picture here from the manufacturing difference, and that's feeding really into this global commodity price slump, let's call it, that we're seeing. Because the difference between that and services, obviously manufacturing uses a lot of commodities, and that's why commodities are under fire at the moment. And right now there's no real reason to change it. But on the flip side, the services seem to be keeping economies afloat. And for some economies, it is the bulk of the economy, like the UK. So manufacturing, this number looks bad, but it represents only some 12 to 15% of the economy, whereas services makes up the bulk of the rest. So not overly important in those terms, hence why growth is looking a bit more positive, because it's being led by services. Coming over to the Bank of England, and Reuters poll says that 48 of 50 economists see the bank rate rising by 25 pips at the June meeting, rate to 4.75%. That was from 4.5% in May poll. So people are expecting the bank to keep rates on a bit of a pause, maybe. They see the bank rate peaking at 5% in Q3 versus the original forecast of hitting 4.5% in Q2. So my magic 5% number getting closer and closer. BOE's Man says the gap between UK headline and core inflation is more persistent than in the US and Eurozone. No shit, Sherlock. If firms have high pricing power, they are going to use it, she says. Riksbank's Bremen says a 25 pip hike in June or September is most likely. Still moaning about the weakness in the crown. Says if we see that the crown weakens to the extent it counters our attempt to bring inflation down, that would have a policy implication. So this is a central bank. They've been moaning about the crown, as I say, for quite some time now, and have hinted that they will use policy purely against moves in FX, perhaps more so than what's happening with inflation. So tipping the hike for either this month or September. Over to the ECB, and ECB's Ren says core inflation must slow before the ECB would mull easing, and the monetary policy journey is not over yet. Well, he got his wish today, because inflation dropped more than expected in the Eurozone. Headline coming in at 6.1 versus 6.3 prior. 6.3 expected and 7% prior. The core number as well coming in much better, 3 pips lower than last month and beating expectations by 2 pips. So little bit of easing of inflation pressures for the Eurozone, main number there. Not wholly unexpected given what we've seen from all the different countries, France, Italy, Spain, Germany, etc. So no big surprise there, which is why we haven't seen that much of a market reaction so far in the euro, because it was pretty much expected. ECB's De Guindos says 25 pip rate hikes are the new norm. The ECB is nearing the end of its tightening cycle, but the final stretch remains. ECB's Not says not unlikely that 2024 rate cut bets will have to be adjusted. So he's given a warning to all those who think they'll be cutting sooner rather than later. Fed's Bowman says residential real estate appears to be rebounding with implications for central banks' inflation battle. And while lowered rents will eventually be reflected in inflation data, home prices themselves are leveling out. Now, as just mentioned, the JOLTS number came in very strong. And what we saw after that was the market getting all hawkish over what the Fed's going to do. Rate futures went on to price a 71% chance of a hike. And that was running at around 63%, as mentioned yesterday, before the JOLTS numbers. So a little bit of a more hawkish step after that JOLTS data. However, later on yesterday afternoon, yesterday evening, Fed's Jefferson says a pause at the coming meeting doesn't mean rates at a peak, and skipping a hike would allow time to assess the data. The extent and effect of tighter credit is not yet clear. Then Fed's Harker popped up saying, I am in the camp coming into this meeting that we can skip a meeting. Incoming data may change my mind. A pause says you may hold there for a while, and I don't know if we're ready for that. Now, these comments pretty much have flipped the market now. We have priced out a rate rise for June at the Fed. It's now a 60% chance that they keep rates unchanged and a 40% chance that they hike by 25 basis points. So the market has really done a big 180 on that. Now, two things. I looked up these guys' prior comments. Fed's Jefferson is perhaps the surprise, being a bit dovish in those comments because he's not really said an awful lot since coming on board. He is a voter, as is Harker. Now, everyone's jumped on Harker's comments, but I've looked back at my flow show notes to see when he was last speaking, and it was way back in February that he was already touting that if rates got above 5%, he would look to pause, in his view, further hikes. So this is not new news from him, but the market has jumped all over that and, as I say, reversed the expectations for the Fed. We then got our mate Timmy Leaks popping up with a story after those two had spoken, pretty much repeating that Fed members see a pause at the June meeting. So we've done a 180. Not that you'd know it from what's going on in markets, which are pretty much the same as where we were yesterday in things like the dollar. Have a quick look, something, the go-to pair, dollar yen. Pretty much where we were yesterday. We had some moves overnight based on the data. Also had those comments coming out as well. So that hit the dollars as we got that flip in rate expectations, but we've come all the way back again on that too. So every time we see this now, we're going to be swapping between these rate expectations and trading between these rate expectations. And what we have to be aware of is where we're at going into the meeting. Are we back to being hawkish? Or are we sitting on a dovish slant? This is where the data is going to be important. Obviously, we've got the ADP coming up today and then NFP tomorrow, and also the ISM today. So these rate expectations are going to potentially flip around a lot. If the data's all soft today and not looking good, then expect hikes to be priced out even further. But as I said, it's not having a material impact on the pricing at the moment. So it's going to be potentially short-term moves in all this. But we'll look at prices a bit more in a moment, just to finish off the other headlines. The US has passed through the first hurdle of voting through the debt ceiling deal. So that's on to the next house. That's all gone through fine and dandy as expected. For all you oil traders, be careful if you're holding positions going into the weekend, because OPEC has barred all major press outlets from the weekend meeting in Vienna. This was at the behest of the Saudi energy minister, who has been moaning that all the press sitting on the doorstep of these meetings, and they get all the he said, she said leaks, and ministers giving their view and comments, and all those headlines have been moving markets, not necessarily the way that they wanted from their decision from these meetings. Now, as we heard last week from one of the big Saudis in the energy space, he was warning speculators, if you remember, about getting too far into things like shorts, and warning that they could see another move that we got in April when we had that decent gap up that caught a lot of people off guard. Which was, let me get it up there just so you can know what I'm talking about. So this move here, when we got this big gappy move up here, he was warning about that. So it's the Saudis that have banned all this press, and in my opinion, that leaves a bit of a risk, that as there's not going to be any press there, they want some bang for their buck in whatever they announce, if they announce anything at this meeting. So they want oil prices higher. So traders could be facing a bit of a gap risk if you're short oil going into this meeting, into this weekend, because if they do hit with big production cuts or something that's bullish for oil, there's going to be a potentially big gap opening up. How long it lasts, whether it closes up like last time, who knows? Whenever they do these things, they tend to fade. But as I say, if you are trading oil and you are particularly short oil, you'll be very careful going into this weekend, because there is the potential for some gaps to happen there if there's big news. Still, you got anything that's fallen into your radar?
No, you covered all the data. I mean, the main thing for me is inflation, and it's dropping, right? We're seeing it in the Eurozone, and I think we're going to continue to see it in the US. UK maybe a little bit more sticky, but what I'm going to say, I'm going to repeat. We saw yesterday the market getting really excited about JOLTS, and I'm sure if the payrolls come in strong, they're going to get excited. Oh, more rate hikes and this and that. I have to remind everybody, why did the Fed start hiking like crazy? Was it because the employment market was great, or was it because inflation was shooting up? The employment market has been very robust for years now. Hasn't really changed. Okay, yes, the unemployment rate has come down over the past years, but it's been relatively steady at very good levels for years now. So what was the driver for the Fed to be hiking? Inflation. For me, 95% of the reasons why the Fed's hiking is inflation. And what is the Fed going to be more affected by? Really strong employment or dropping inflation? I think dropping inflation is going to be trumping everything else. So before people get really excited and say, oh, 300K job payrolls, NFP coming up. Yes, oh, fantastic. Well, if inflation is going to be dropping more towards target, I'm not going to say it's going to hit target, but towards target, it doesn't matter if we have, 200, 300, 400K NFPs. It doesn't matter as much, in my opinion. That's why I want to make this clear that this is the way I'm looking at it. And it's also the case for the Eurozone. So if unemployment in the Eurozone is steady around 6.5%, has been for a while. If unemployment starts dropping fast and starts looking really good, well, if inflation drops as well, I think inflation is going to have a much bigger effect on the ECB. And let's not also forget what the main bias for all central banks is. The bias is to hike and tighten as less as they possibly can, because they know that this is going to bring downward pressure to the economy. This is a economics 101. You tighten the conditions, you're going to put the brakes on the economy. So they want to tighten as little as possible to bring inflation down without causing havoc to the economy. So just keep this in mind. I always do. I always place a lot more importance on inflation than employment, at least in the current environment, because inflation has been the main reason why we've seen all these rate hikes pretty much everywhere. Just want to reiterate that to make it as clear as I can. This is my humble opinion, as always. People might disagree, but that's me. On the other hand, you mentioned the debt ceiling passing the House. Now we're waiting for the Senate. Apparently, this might be a little bit more tricky, but let's face it, they're going to do it. They're going to pass it. There's going to be the odd voices saying, "Oh, it's unacceptable." Of course it is, but you're still going to pass it. So I remain of the opinion that as soon as that gets passed, I think risk will spike. I'm not saying it's going to be a big move, but when we get the headline, I'm going to buy the S&P wherever it's trading, put a relatively tight stop, and I think that's going to be a knee-jerk reaction, which is unavoidable. A lot of people say, buy the rumor, sell the fact. I think the fact has not been fully bought yet, or the rumor has not been fully bought yet. So I think that's going to be the reaction. Anyway, just my 2 cents on things.
Thank you very much, mate. Wise words as always. And yeah, it's important to remember what the mandates are at central banks and for the Fed. It's maximum employment and inflation under 2% or around 2%. So they've got a big fat green tick on the jobs side, but have still got a bit of a red cross on the inflation side. But remember, inflation has gone up. The last PCE numbers, both measures, core and headline, went up. So they're definitely not out in the woods there. So what do you think for June right now, standing here right now? Do you think they're hiking or they're pausing?
It will depend on the CPI print, but the market's pricing 50-50, actually slightly more than 50-50 that they hike. I think we're starting to get to the danger zone. I don't think it's going to be as simple as that or as clear as that. If we start pricing more than, say, 70% chance of a hike, I think it's probably worth going against that. My view is that CPI is going to determine in a huge way the next meeting. And and as I've said before, I think CPI is going to continue to come in soft and move towards, I'm not saying it's going to get there now, but move towards target slowly but surely. And if the Fed sees that and they see the trend still being intact, if this reading is at expectation or lower, I think the Fed is going to be very comfortable saying, look, we're going to pause. We've already had Fed members say this, right? We could pause and then reconsider and reassess. They've said it already. So what is there for them to lose by pausing while inflation looks like it's continuing to go lower? They have very little to lose. The credibility, they don't have any left, but it's not unreasonable to say that we're going to pause given that inflation has dropped for 8 months in a row, or however many it is. So it's not unreasonable to say that.
Yeah. Okay. So I mean, I'm a bit on the fence as to whether they hike or pause. The next CPI numbers come a day before the FOMC, which the FOMC is on the 14th of June. So we get the CPI readings 13th of June. So it's going to be a big old day for the market.
Yes.
We're going to get some last minute jockeying around in those expectations for the Fed anyway.
Well, they're going to probably get the number a day before, right? They usually, it's not official, but they usually do. Anyway, it's before the FOMC. That's the main thing.
Yeah, well, the FOMC is a 2-day meeting anyway, so they'll have started on the 13th anyway. So they can, even if they get the data on the day, they've still got another day to chew it over and do whatever with it. But yeah, it could be a pretty volatile day before meeting day for trading. And then if obviously if it comes in softer CPI, that probably cement expectations for a pause from them the next day. So in fact, all the moves could be on that 13th rather than actually on FOMC day. But we've got plenty of time until we get to that date there.
Well, I just saw, by the way, we've had 11 prints of dropping CPI in the US from 9.1 down to 4.9. So, the trend is there. And if you look at the chart, actually I have it here. Let me show it. Hold on. Just from investing.com. So it's
I've got it.
I took the screen. Sorry.
You got it, Tom.
So look at how symmetrical this is looking. So by even just straight extrapolation, I know they're going to do that, right? If you extrapolate within 3, 4, 5 months, you're back down to 3%, which is then all clear for them to just say, we're done. So why not wait? If you get the next reading at, what are we expecting? Actually, I don't know what we're expecting. But if we get something like, 4.5%, we're on our way. It's not unreasonable to expect that. And the Fed are, as I said before, looking for reasons to stop. I think this will be a very, very good reason. Anyway, just a nice, interesting chart to show.
Yeah, thanks, mate. Do you want to have a look at anything? I was going to say, do you want to have a look at anything while you've got the screen?
Yeah, of course. Yes, I can. Yeah, actually, you are right. Let me go. You can see my screen?
Yep, all good.
Perfect. So that's my main view on the US, and let's face it, the US is the Fed is driving everything. As soon as the Fed said, yeah, we're very close to pausing, suddenly you get other central banks getting close to pausing, and yeah, okay, maybe they have a little bit of a lag, but the Fed is still the most important central bank in the world. It's the reserve currency. Everybody follows, even though they don't say it. So yields, well, I drawn this here, and I said it yesterday, or the day before. When was it? That I was talking with a friend, and it was trading at 381, and you're saying, that's it, I'm going to go long 10 years. I said, well, technically, you want to wait for 390. I'm going to wait 390, and he goes long, and I didn't. So who's the smart one? So I missed that, but we're now in the middle of this range. It's actually relatively good support here. It's the 50% fib of this move, and it's also the 200 DMA. It's kind of an interesting place for a bounce, and we are seeing this bounce, but we are, anyway you see it, we are in the middle of the range. I would love to see a move towards 390 or 389 or wherever that will come in now. I doubt we'll see it, maybe with a really strong non-farm payrolls and maybe a couple of other good numbers and dollar buying. Maybe we'll see that, but I think this is a sell in terms of yields up here. And as I said before, I think the Fed is going to be pausing, most likely going to be pausing and done relatively soon, because inflation is going to settle at relatively normal levels. I don't think 2%, but 3% is not unreasonable. And so that for that reason, I think the yields are going to be dropping and grinding towards this support. What do I think happens? I think this support gets taken out, and I think really we're going to the kind of medium term resting area is going to be around 250. I know it sounds crazy to say it, but that's my view. And so yields for now are doing nothing, are driving nothing. It's still about the dollar. Yields are in the middle of the range. So the dollar, well, I said I think we're going to get to maybe one last hurrah towards 105.50 in the Dixie. If we get that, then most likely the 10-year US has gone to 390. And I think it's a sell for both the dollar and yields. So, long bonds and short the dollar. I would love to see a test of this 105.50, 200 DMAs coming there. It's the previous highs. It's also been the lows for a couple of times. It's a nice little area. If that gets broken and we go higher, then all bets are off. I think then we're in a different, my kind of macro view is going to change because something will have changed dramatically in the environment. I don't know what, but that's what I'm saying. That's what I'm looking at. So 105.50 is the high, or 50, 60, whatever you want to call that. And 100.80 is the low. This is the range. I would love to play that range to the short side if we get up there. So by definition, the euro dollar is the opposite. I'm not going to show that. The cable and the pound is doing okay. The cable's bouncing again. It's not really convincing, but we are kind of broken out of this channel. It's taking too long now, so I'm tempted to delete this channel altogether. It's not looking very pretty. But if you ask me, what currency do I like for the remainder of the year from these levels? I'm going to say the sterling and the Norwegian krona, which has had its ass kicked for the nth time, nth
Don't
day
even
in a
don't
row.
even show that one. Don't even show that one.
Yeah. I mean, it's crazy. It's
It flew
insane.
off the top in some style
Yeah,
yesterday.
that was big. But having said that, I shorted the 1190, right? Or 11,895, what was it? So I would
Yeah,
still be out of the money even if I hadn't stopped out straight away. So it's still not showing weakness in any way, this pair.
yeah.
I
I
really
just
think
want to chuck
this.
in, if I
Yeah,
can, mate. The
yeah, of course.
Norges Bank were out with their FX report, and they only cut sales by 100 million to
Yes,
1.3 billion for June.
yes. So they're the main mover, right? They're still
Yeah,
the Norwegian kroner's worst enemy. At some point they're going to stop that, but as long as this trend is here, I really would not want to go against it. I want to see two things happening. First, this trend line getting broken, but really these lows get taken out. 1147. That gets taken out, I'm going to be very interested because, as I've said before, I think this move lower, when the macro environment changes, when sentiment and everything changes, it's going to go a long way. It's going to go down to the 1020 relatively quickly, I think. So I don't mind losing the first 400 pips or that's 4,000 pips, isn't it? No, what is it? Whatever.
yeah.
400 pips. And get the rest. So I'm still looking at this like a hawk, but not touching it. Same with dollar Norway. Dollar Norway, I want this to take out, these previous highs are going to be support, but we need to take out the trend line as well, come within this range again, and then I think it's going to have some pretty nice potential. But at the moment, I'm not touching it. Stocks. Well, stocks. What have I been saying for weeks and weeks? They're resilient. I mean, look at this chart. Yes, we have the odd up and down day here, but it's still really close to these highs and it's really flirting with them. And when the debt ceiling gets passed through Senate, I think we blow right past it. I don't think we have a huge amount of travel after that. I think 4,300 is the place to unload longs. So it's going to be a quick trade for me if we do get the resolution, or when we get the resolution and they pass it through Senate. I think we probably, the target's going to be something like 50 to 70 points once that happens. But still, I think it's a relatively high probability trade. I'm going to get long, put a stop relatively close, and then excuse me, then watch it. But I'm going to repeat. I would really not want to be short stocks here, the end. DAX is relatively similar story, very, very close to all-time highs. I mean, this is even better looking than the S&P because we are so close to all-time highs. So one of the most bullish events you can have in indices, in anything, is you take out the all-time highs. Some people think the other way. Oh, it's taking out the all-time highs. It has to reverse now. I think it's one of the most bullish events you can have in anything. So the DAX is looking very, very strong so far. And it's up 1% today. I mean, Jesus. Metals, same story. Gold is still resilient, looking very good. This retracement is very shallow, 23.6, and still hanging around this level. And this, remember, is all with the Fed hiking and the dollar rallying and everything. So this move here, which is now almost a year. No, it's less than a year. But I mean, this move here has been really impulsive, really strong. And the, higher highs, high lows, the pullback is insignificant, really. You have to, if we take out these lows here, then yes, we'll go towards the middle 1800s. But still, that's not an unreasonable pullback to expect given the global circumstances. And let's not forget gold, silver, they are an inflation hedge. They've shown it time and time again. It's not an immediate inflation hedge. They've shown that as well, time and time again. If you look at the times of inflation in the past 50 years, metals always have a lag, always. And we haven't seen this move yet in gold, and we definitely have not seen it in silver. Silver is drawn lower because of its industrial use, and China is affecting it, and the kind of China is not really opening up as markets have expected or hoped for. And it is underperforming, but I think silver has the best potential by far when things start going with metals. I mean, it's gold on steroids, always has been. And also, if you add to that the fact that all this new technology, EVs, solar panels, everything, all this green technology needs silver in big quantities. I mean, that's what I don't get. Last year, I think we've had now 2 years in a row of a deficit in terms of actual physical silver supply versus demand, and this year is going to be is projected, as far as I remember, to be worse than last year in terms of deficit. So how can silver not be taking out the highs and making new moves higher? Well, it's simple. It's easy to explain. For some stupid reason, the dollar now strengthening 2% means silver has to drop 15. It makes no sense. Absolutely no sense to me. So I'm, everybody knows I'm long a full position of silver from below here, about 20 cents below on average. I've decided I'm going to add more, so I'm going to get more than one position long. I rarely do that, but I really like this trade. I'm going to do that if we get towards these low 22s around this circle here. I'm definitely going to try that. And unleveraged, as always, people know how I trade. I'm not suggesting you do the same. And platinum is also underperforming. If you look at gold platinum ratio, actually, let's have a look at that. If you go back enough, platinum has had one. You see, it's been rising, and it's been near highs. Okay, it did jump in during COVID because gold did a lot better than every other metal on the way down. But platinum has had the problem that one of its major uses, which is in catalytic converters in cars, has been reduced massively due to electric cars. But that's now priced into the that the price. It used to be the platinum was quite a bit more expensive than gold. I remember when I bought my my wedding rings, I said, the guy said, do you want gold or do you want the expensive platinum? I'm going, yeah, let's go with the expensive platinum. No, it's now worth half of it. Anyway, it is what it is. But platinum, I think, is also going to perform on the way up better than gold. But we have to be patient. We have to see the breakout in gold. Gold is going to lead the way, I think, in terms of the move and the trend. We have to see gold taking out these highs and the all-time highs, basically. And then when that happens, watch out for these two. What else? Well, always worth having a look at crypto. I was reading some headlines today about some was it another lender who's in trouble? I have to check. Binance tweeted something about some other company. If anybody knows, they can help us. So this is putting pressure on cryptos because this is potentially another horror story coming. I've said it before, cryptos are underperforming quite substantially. But I wouldn't be short here. I would only be short below these lows and after the debt ceiling is passed and we see the move in the equities, gunning higher in the short term, because as I've said before, and if you see the S&P going up, 2, 3, 4%, I don't think crypto is going to be down. They're going to be up, but they're going to be underperforming. So I'm waiting. I wouldn't get short here if you want to be short, but I'd wait for these lows to get taken out. That's enough of me babbling, I think. Anything we want to add? Anybody wants to add? Silver DMA 100. Let's have a look. The 100 DMA. I don't know. I don't look at that. Let's have a look at that. Oops, no, that's it. Let's have a look. Well, yes, we are at the 100 DMA. I look at the 50 and the 200. For some reason, I don't look at the 100. But yeah, so technically, maybe you have a reason to think there is support here. I'm not that convinced yet. If the dollar goes to 105.50, which I think it's 50-50, probably more likely to go, I think we're going to get down to 22. So I'm patient. As you know, I'm already long, but I want to add more, but I'm going to wait for this level if we get there. If not, and we break out, well, I'm going to be happy about my existing position. So, either way, I'm not too bothered. Okay, that's it for me. I will give you back the screen.
Right. Let's hope I can grab it and I don't get that bloody problem.
No, you're good. Start. Yeah, we can see you.
Cool. Good stuff. Good stuff.
Awesome.
And he's just asked about Lagarde. She's been out since the CPI report, pretty much brushing that report under the carpet, saying inflation is too high and set to remain so for too long. We need to continue our hiking cycle until we are sufficiently confident that inflation is on track to return to our target in a timely manner. No clear evidence underlying inflation has peaked. So that's a little bit hawkish comments there after those inflation numbers. Not that the euro's really moved on it at all. It's got about 15 pips on those comments. So the market pretty much set. Let's have a quick look at the rate expectations. What are we looking at for that? Running at 86% for a 25 pip hike and 14% for a 50 hike. So on the hawkish side for those, but otherwise nothing too strong from the guard.
50 is unlikely, I think. We have to
it's just how the metrics work on this thing. But 50 is definitely off the table. But well, let's see if the market, what it does with those inflation numbers. And but again, this is the ECB doing what they like to do, which is when they've got a message, they keep that message and they keep that message going. It's not like the Fed where, you know, we had the pivot players trying to get in and second guess what the Fed would do and trying to predict rate cuts. The ECB, they're on the hike path until they actually say they're stopping. They're going to keep going, and they want to maintain that message. They don't want the market to give the market an inch in undoing hikes by way of market pricing. So expect them to remain hawkish until inflation is really starting to get down. I don't think they will start turning until inflation is probably down around 3%. If it gets there, that's when they'll really start to go more neutral, shall we say, but expect them to continue. The euro in the meanwhile, we're messing around this 107 level after the breakdown yesterday. It was holding below 107. I had a little bit of a short on that, a little bit of a scalp. I took some money off and then got hit on the trailer on the way back up. Let's see if we can hold in this move, hold this 107 area. If we can, then maybe we get a move back up to the recent highs around 40s, 50s, and then that big 107.60 level. But if we fail here in the next few minutes or hour or so, get back under that 107, it's going to keep the downside pressure when in play. But we need to see now these lows down here, which was, if I'll show you on this chart, probably was a bit of an on-off line. One of those ones where something might happen, something might not happen. Not necessarily one I'll trade, but as you can see, the prior price action around 106.40s, 30s, 40s has been something that's happened in previous times. So keep an eye on that one. 105 is still my big number down below for that. Dollar yen, still, it's not really taking back what it gave up off that move towards 141. So it has bounced pretty much off the support down here, off the big figure. Even if it's dipped under by a few pips, you can probably drag that down to about the 80 level as support down there. But as you can see, we have turned. We're now making lower highs and lower lows. So potentially we've turned the corner there regarding that move off to the highs, but not coming down too far just yet from that one. I'm not so sure. And who is it? GW's made the point, Stel. You know, when this, I'm wondering if we are pretty priced in for this debt stuff now. The Senate vote should be a.
Give me a second. Somebody's calling. I'll be right back in 1 minute.
Yeah. Well, just to answer GW, I agree with you. The Senate vote, the Senate is the Democrats' house, so it should pass through there without a problem. as you say, bar any last minute screaming and shouting. So I'm not too sure what the reaction is going to be after that in terms of a confirmation move. It could be pretty limited, or at least not last very long.
Sorry. What were you asking me? Sorry, had to take that.
Yeah, I was just saying, I'm agreeing with GW. I'm not sure if there's going to be a big reaction if the vote through the Senate passes, because the Senate is the Democrat House, so it should. The risk, I think, was the Republican House, so it should really fly through there. I'm just wondering if the reaction afterwards might be a bit muted in terms of what the market does. It's a slam dunk.
Yeah, I still think the reaction is going to be positive. I mean, I think it's just the way markets. Well, actually, no. It's my view. I mean, I don't know. It's there's arguments for both sides, but it is. I think that's how it's going to pan out. Just my humble opinion. Sell side will pile in. Yes. Sorry.
So as I was going to say, your opinion is always welcome, mate.
Yeah, and DJ says sell side will come in, will pile in. Yes, but I don't think straight away. I think the rally is going to get sold into, but not straight away.
Yeah. So it'll be what it'll be, and we'll trade it accordingly. We can all have opinions, but the market's going to tell us what it wants to do at the end of the day, and we can only react to it, and that's what we'll all do. Right, just flipping on to some of the other pairs. Aussie dollar finally out my shorts from the 68s. Got hit on my trailer at 65.15. I got out some down below 65 yesterday, last slice really, and then I yanked my trailing stop down. So I'm out Aussie shorts at the moment. For me, it's a case of just watching what we do against the levels here. We are continuing to break lower. We're now holding below 65.20. So that was my zone down here. As you can see, we're finding resistance into that. That keeps the downside in play, though we are finding support again against this older level 64.80s. So just again, you're looking for signs. If you want to catch the knife, you're looking for signs where you get a bottom that holds for a considerable period. It did look like it was doing that perhaps here, but then this break completely invalidates that. And so we keep searching for a bottom, and until such time as we get a real solid bottom, you need to be careful if you're trying to catch that knife. What you want to look for is what happened down here back in October. This is where I went long against these levels down here, because we had that low, then we stepped up, held the big support, and then we stepped up again. So that was over a period, pretty much most of October. So that's the sort of time you want to start seeing bottoms forming. This isn't that at the moment. There may be something for you scalpers, but if you want to try and catch the real big bounces, you've got to look for a real extended period of finding support. So for me, this is the door still open for a move lower. The traffic down around here is a bit messy. So really only if we start getting down to maybe the 63.5, those sort of levels will I start getting interested again, because then we may be setting up for another test of these lows. And if it holds around 62, that has the potential for a very decent double bottom, and then maybe we have another strong rally. But for the shorter term, just trade between the levels really. If you want to try catching those knives, you know where to do it. We've got a battle here: 65, 64.85, and 65.20. So that's your market, or that's your ballpark for now on that one. Euro sterling has made the break under 86, and now it's failing to get back above that, as you can see there. Again, it's another one where we've had support building for a long time, couldn't get through, but the bounces were very weak as well. We had the break, we're down below this, we're holding it as resistance. Now we're seeing where the next levels are coming in. Let's just come out to a wider chart. So my level down here really is at 85.70, and we've got close-ish, not close enough for a proper test. You can see it's a previous level that's gone back quite some way. Bit of traffic here, support, had a bit of a break, but it's then held again. So If we get under that and then under 85.5, then I think we're going to be down in the low 85s, maybe even worse, down towards the 84s. And again, we then be getting into an area I'll be getting interested in again for the longer term, because that would mark down here, maybe down in these 83s, 82s. Again, strong support areas. This is where the real stuff happens. So if we get down to those levels, I'll be maybe looking at putting on some longs again, see if we get another bounce and where it goes from there. So I like to look for these big longer term levels because those are ones that bring the big rewards. As for dollar CAD, well, I didn't actually take it, but we hit that bloody 136.50 again yesterday. I was speaking about it. It's happened over face as we were talking about the GDP numbers, and it's held once again. It really is quite a level at the moment, and that sent us all the way down near support around 35.50. Not a huge level, certainly not as big as 136.50. But obviously keep an eye on what's going on in oil. Again, this one is gaining while oil's doing not a lot. So you'd expect if CAD's gaining, oil might be rallying. But as you can see, it's not really. So we're off that bus for the moment, it seems. But just keep an eye on what oil's doing. And as warned, watch out for that meeting coming up this weekend. But if we got further downside for the loonie, then you're really going to be looking at down into this zone again, into 135, maybe down to 134, 60, 70 area. If nothing's really happening with Canada and whatnot, this can be a real good one to play, just pinging between the decent levels that show up. So keep an eye on this one in the first instance, and then potentially down to 135 in the second. Yeah, still mentioned Euro NOK, so I'm not going to look at that one. That really was a bit of a mess yesterday.
Breaks my heart every time.
It does. Oh, we'll look at it. We'll look at it quickly. That was yeah, because I was in the 90s, just looking. My first profit area was down at this 1185, and it even went through that down to near 1180. But yeah, I don't think it's out the woods. I don't think we're done with the upside, particularly given what the Norges are continuing to do, being one of the biggest sellers in the market. Anyway, enough of that one. You guys got anything you want to have a look at? Cable? Are we at that magic level? We are. Look, 124.50. Here we are again. That bloody level.
Magnet.
It is a bit of a magnet, isn't it? Oh, let's get the charts in the right place. So, well, we're actually above it. But look, just in the last hour, it found resistance there again. Found resistance yesterday again, but now we're having a bit of a break. So maybe this has a little look up at 125. Really, this one is playing half figures and big figures all the way up. 125.5 there, then up to 126. 125 is a bit of an area as well. So, keep it simple. Just play the half figures and big figures for this one for the moment. Anyway, no, you're right, Andrew. No need, no reason to revisit if that's the case. Right. Well, cool. Unless you guys have got anything in particular you want to look at, we might call that a day. As I said, just to remind you what's coming up later today, we've got jobless claims, the ISM, big ISM manufacturing for the US. So keep an eye on those data points coming up a little bit later. And on that note, we shall say thank you very much. Have a great day. Thanks, Delius, for all your good charting and techers. And see you tomorrow.
Thank you, everybody, for being here and keeping us company while we're babbling on. Thank you, Ryan.
A lot of babbling. We should change this to the babbling show.
Cheers.
Cheers, everyone.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.